Retail stocks taking center stage as the holiday shopping season kicks off on Friday. And we've already seen some big moves this week with Nordstrom sinking on results, Urban Outfitters soaring. Meantime, the XRT retail ETF is on pace for its best month since February. Joining us now with the names on his shopping list, Neuberger Berman portfolio manager John Sanmarco. John, good to have you. I think Ulta Beauty is one of the names on your list. That stock had a good day, up about 4%, but it's way down, almost, I think, $200 a share down from its highs earlier in the year. It was over, I think, 560. Now it's at around 375. I had a guest earlier today on CNBC arguing that the downswing in beauty has only just begun. Why do you disagree?
John, great to see you. Thanks for having me on. So beauty just doesn't lend itself to violent pendulum swings. It's a highly consumable category. I mean, they named a academic macro theory after the lipstick effect, and in our experience and in the data, we see that the category does behave accordingly. It's a very affordable luxury for consumers who are using it up. It expires. There's a constant flow of innovation that expands the category and makes it interesting. And maybe the last thing I'd sort of throw in there is just that you have this demographic expansion of the category. Consumers are using it younger and younger, and there's more use cases for older consumers as well. So great category, and would respectfully disagree with the other viewpoint.
Okay. How do you make sense of this dichotomy that I seem to be hearing on the consumer as it affects retailers right now, where on the one hand, the consumer looks pretty healthy. The PCE numbers today suggested that things are okay. But on the other hand, you have stretched credit. You have Walmart and Amazon saying that consumers are being really choosy about what and when they buy. They need discounts. And you've got a shorter holiday shopping season this year than we've seen since 2018.
Yeah, I think the results that we're seeing in the consumer's behavior and where they're spending their wallet lags the sort of obvious inputs. It was quite a bit after inflation first spiked and food prices, really started to increase, and gas prices too, going all the way back to 2022 before you start to see some of that pain slowly leak into the retail space. And I believe what we're seeing now is the opposite, which is real wages have been positive for quite a while. Significant cohorts of consumers have balance sheets that are in pretty good shape, particularly homeowners. And yet, to your point, we really haven't seen discretionary come back yet. I think prospectively, all things equal, without any major market disruptions, I believe we'll see the consumer behave in a little bit more healthy fashion looking forward.
How much should the retail investor be concerned about a dynamic where perhaps some retailers are trying to get inventory into the country now ahead of tariffs, but at the same time, it's the holiday shopping season, so they got to manage that, and it's shorter, so they might end up having to discount to avoid having warehouses too full, and that might hit margins?
I don't envy the folks whose job it is to figure that out. Tactically speaking, in the industry, it's a really tough job right now. It was made much harder by the volatility around the election. It was made much harder by a very unhelpful fall from a weather perspective. And so, I think from an investment perspective, just taking a step back, a name like TJX, we own in the Connected Consumer Fund, they can capitalize on some of that unpredictability of the business and buy stuff opportunistically. But I really do think a premium on high quality retailers that offer, sort of an unbeatable consumer value proposition is paramount.